We're going to introduce Chapter 20, Accounting for Leases, today. This one's, of all the chapters and all of intermediate, probably one of the most straightforward ones. So you'll be happy to know. So I'm going to introduce it today. Next Tuesday, I'll finish it up with the numerous problems on the board. Next Thursday, 1 week from today, I'll review for the second and final midterm. And that will cover the 4 chapters that we've discussed since the last midterm. All right? And then that midterm will be the Thursday after, okay? Which I'll explain all this next week. Okay? All right, so leases. Leasing is an agreement between 2 parties. Could be individuals, it can be companies, could be a company and an individual, could be an individual and a company. Just 2 parties. One party owning a piece of primarily tangible property, and the other one needing access to it. So that's a lease, straightforward. You all, well, maybe not. Most of you have leased an apartment at some point in time, or you probably will in your future. You're leasing a dorm room space from the university, in essence. And so in business, it covers the gamut. Businesses lease office space, they lease warehouse space, they lease retail space, they lease trucks and airplanes and boats and ships and cars and you name it. Factory equipment down to copiers and telephone systems and fax machines. So leasing is a large portion of transactional data that occurs on an annual basis. So I just talked about that. The lessee is the one who needs access to the asset. In exchange, they will give up some sort of payment, and the lessor has the asset that the lessee needs to use. Leases are basically 2 types under U.S. GAAP. And I emphasize U.S. GAAP because the international rules do not allow this latter portion. So they're either a capital lease or an operating lease. We'll start with the latter. An operating lease is strictly rent. You don't have a liability. You do not have an asset that you put in your property, plant, and equipment section of your classified balance sheet. Every month, you just write a check and expense it. Straightforward. A debit to rent expense, credit, cash. A capital lease, however, is the lessee is in essence buying the equipment, even if they don't have the rights to it when the lease is over. And I'll tell you, I'll clarify that. So a capital lease requires that the lessee puts a tangible asset onto their classified balance sheet and then depreciate that tangible asset over a period of time. All right? And I'll tell you why I didn't say useful life, because it may not necessarily be over the entire useful life. It also requires that you set up a liability of the present value of all the future guaranteed lease payments. All right? So which one do you think businesses in America go to great lengths? I mean, there's a whole cottage industry in the United States to ensure that you meet one of these 2 types of leases. Any guesses as to which one is more favorable for the most part? Operating leases, precisely. because you do not have to put the debt on your balance sheet. And if you borrow money from a financial institution, more than likely you will have what is known as a loan covenant. You'll have a bunch of loan covenants, but you'll have a specific loan covenant that says you're not allowed to go out and borrow money from anybody else over a very specified amount. They may tell you you're not allowed to borrow anything from anybody else other than trade accounts payable. So if you need a piece of equipment, whether it's just a copier or a big piece of manufacturing equipment, if you need that in order to conduct your business, your only option under your loan covenants is to go out and contract with a lessor to do an operating lease. Okay? So what's the difference? In U.S. GAAP, the reason we have 35,000 pages, once again, of U.S. GAAP compared to the international rules of 3,500 pages, is we have very bright line rules that tell us, is it or is it not an operating lease? So there are 4 rules in leases that we deal with in the United States. If you meet any one of the 4 rules, it's a capital lease. So in other words, when you need to avoid violating this loan covenant, you better make sure that your lease that you're getting ready to sign does not meet any one of these 4 rules. Does that make sense? And the rules are very straightforward. Do you acquire the property? You're the lessee. You're the one leasing the property. Is it yours at the end of the lease or at any point in time? Do you actually gain legal rights and control of this asset? Okay? 2, can you buy the asset for a bargain purchase price? A bargain purchase price, a good example is Dell Computer leases laptops. Well, they lease all sorts of stuff, up to servers. But they lease laptops, typically for 3 years. At the end of the lease, you can buy that laptop from Dell for $1. That's a bargain purchase option. All right? Because the laptop's still worth probably, I don't know, $400 or $500. So you are, in essence, buying that laptop. Okay? Is the term of the lease equal or greater than 75% of the useful economic life of the asset? If you're leasing a piece of property, a delivery truck, with a 5-year life on it, for 4 years, it's a capital lease. If you lease it for 3 years, it's not. All right? See what I mean by bright line rules? If you're on this side of the threshold, you've got an operating. If you push it to the other side, you've got capital. And the last one is are the lease payments equal or greater than the present value of the lease payments equal to greater than 90% of the fair market value of the asset? So if you're paying the lessor 90% of the value of the asset, you are, once again, in essence, buying the asset. All right? Does this make sense? Does ownership transfer? Is there a bargain purchase option? 75% of the life or 90% of the value? Any one of those 4 criteria pushes you into a capital lease, requiring you to debit leased property for the present value of all the lease payments and credit lease obligation, a liability, thus violating your loan covenants. And oftentimes, when are you going to have this argument? With the lessor? After the fact. But who's going to first come in and tell you that you have not met one of these 4 criteria? Your auditor. And when are they going to do that? February, March, after year end. They're going to come in and say, no, 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 this is a capital lease. Now, you've had use of this property and you've been making payments all along for, the better part of a year without telling your banker. Now you've got a very uncomfortable phone call to make. Excuse me, we got a small problem. Because what happens if you violate a loan covenant? Does anybody know?
They ask you to pay it in full, don't they?
Yes, they do. Today. Preferably tomorrow at the latest. Yes, they want their money back. Or what will happen then? You don't have the cash. They will come in and take whatever property that you have collateralized that loan. Ramifications are very strong. So make sure, first of all, that you, as the future controller and CFO of a company, that you review and sign all leases. Do not let your VP of manufacturing, I'm just telling you, do not let your VP of manufacturing, yes sir?
Call the projector wasn't working.
It apparently was a false alarm. Yes, it's working just beautifully. It must be another one. It's another room. Somebody called you. No worries. Make sure that nobody else signs leases. Just caution. Yes, sir.
So, like, how would you try and negotiate terms with the?
There are leasing companies that specialize in this, that know these 4 rules forwards and backwards. It's their core business.
They're just going to charge you more so that it doesn't meet these requirements.
Yes, they are. You will pay for it.
Yeah.
But if you had the excess cash, you wouldn't borrow the darn money anyway.
True.
Yeah.
It's like if you're in a.
And mostly, they go for very short term. If you need a piece of equipment, you'll lease it for 3 years, where the useful life will be 15, and you'll pay. But if you need it in order to produce a revenue project, then you don't have options. So, all right. Copiers are the worst. I'm telling you, people in business will not walk from here to the door for a copier. They want a copier here. And copiers are run amok in a business. They'll be darn near everywhere. And copiers generally do not fall under operating leases. Because Xerox doesn't want to sell you a copier with a 5-year life and have you lease it for 2 years, because then what are they going to do with it? It's a used copier. Nobody wants it. So they're all capital leases. Now, I have successfully argued that it's immaterial, because the income statement effect is nothing, right? Because under a capital lease, you're going to depreciate, plus you're going to accrue interest, all right? So between the depreciation and the accrued interest, it's almost equal to what the lease payment is. So the effect to the income statement is nothing. But the balance sheet effect, and especially the effect to loan covenants, can be dramatic. All right? Okay. So what is a minimum lease payment? Because the present value, the 90% threshold, that last of the fourth rule, is 90% of the minimum lease payments equal or exceed the fair market value of the asset. So what is a minimum lease payment? In most cases, it's obvious. All right? You're leasing the office space for $15,000 a month. Done. All right? But in copiers, I go back to copiers because copiers are very, very complex. Copiers, you normally make a payment per month plus a charge per copy. So somebody in your AP department fills out a little log sheet or goes online and types in the little counter that the copier has on it for every copier in the building. It's insane. But that second charge also covers all of the copier supplies, the toner, all of the little drums that are replaceable on a periodic basis, all of the supplies to run that copier except for the paper. All right? Well, those are not minimum lease payments. That's office supplies. So you need to somehow strip out the cost per page of the supplies and only include in the calculation of minimum lease payments the amount that pro rata per copy amount that is actually equipment rent. And there's formulas for it. Your copy supplier will tell you the two, especially if you're trying to get it to be an operating lease. Okay? So that's one instance. Has anybody ever leased a car? Leasing a car seems very attractive because you can get a car that you really can't afford, a nicer one, for less money. All right? So you can go out and lease for 3 years a $30,000 sports car for the price of a 4-door Honda. All right? But once again, I will caution you. The lease payment is only one charge. They will require that you turn the car in with a threshold of maximum amount of miles. And they typically say for a 5-year lease, they'll say 60,000 miles. They'll initially try to make it 45, 48, something like that. 45,000. 45,000 is 9,000 miles a year. Less than 900 a month. All right? Typically, just commuting. These are no long-term road trips down to the coast and back. Just commuting, you run up 1,000 miles a month. The typical driver drives 1,000 miles or 12,000 miles a year. Now do you see where the problem is? I've known people in my career that have had to park their leased vehicle during the last 6 months that they owned it. Never left the driveway because they were right at the threshold of exceeding it. And if you exceed the mileage, you then pay per mile. And it's expensive. It's cheaper than to go to Enterprise and rent a car for 6 months than it is to pay the mileage problem. So I just caution you on that. And the other thing is that they've got a residual value, a guaranteed residual value, which is you guarantee that car is going to be worth, say, a $30,000 sports car in 5 years is going to be worth $18,000. And if for whatever reason, beyond your control, it's not worth that, you pay the difference. Now the good news is if it's worth $20,000, you've got, in essence, a $2,000 trade-in on a leased vehicle, which is a little weird, but that's assuming you didn't drive it too much. The long and short of it is just buy the darn thing outright. Don't lease vehicles, okay? Nobody in here's parents lease vehicles for a living. I'm not disparaging the leasing business, but it's just not a good investment. Okay? All right. So this is what the minimum lease payment is. And we'll do calculations come Tuesday to illustrate all of this. So under an operating lease, as I said, it's just a debit to lease. Oops, go back. It's a debit to lease expense and a credit to cash. So that's it. Operating leases. Rent expense on a periodic basis. The chapter talks about sales type capital leases on both the lessor and the lessee part. and direct financing capital leases. These are both capital leases, but these are just a specific type. I'm not going to test you on that, and your likelihood of ever running into one of those is very rare. So if you go to work for a large, this normally happens in construction business, so if you go to work for like Hoyt that rents bulldozers and big forklifts and stuff like that, road machine and all that sort of stuff, you'll see this, but outside of that you'd really rarely see this sort of stuff. Okay? So what do we need to do in order to be able to do these problems? We need to know, is there a bargain? What is the purchase option? We need to know what the economic life of the asset is. We need to know what the residual value of an asset, because if it's a capital lease, we need to depreciate it. So we need all the data that we had back when we were doing property, plant, and equipment in order to calculate depreciation under whatever method we use, straight line, some of the years digits, whatever. We need to know executory costs, and I'll come back to that, because oftentimes, especially with real estate, if you're renting a factory or an office space, built into the lease payment, just like with the copier, the lease payment included the supplies, they'll have various what they call executory costs. These are insurance and building maintenance and property taxes and the like that you as the lessee have to pay the lessor, because the lessor will insure the building, the entire building, but they're going to charge you your pro rata share of that insurance, as they will the property taxes on the entire building. So if you're in an office building that's 100 stories tall and you're just renting one office, you're paying your pro rata share of all that stuff. Okay? It's standard in the industry. You will always pay that. But it doesn't count towards the minimum lease payment is really the point. You need to know what the fair value at the time of the lease and what if there is any, what kind of residual value is built in, and then when does the lease start, and what is the interest rate implicit for discount purposes. Initial direct costs, this is another thing. How many have actually rented an apartment, right, so far? Okay. When you rented an apartment, you negotiated up front what they call make-ready. Did you make them put in a new carpet? Did you make them repaint the walls? Did you ask for a new refrigerator? Things like that. It's all negotiable. All right? You did not do that. You can. You can ask for all that. You just walked in there and you're like, okay, it doesn't look too bad. A little spick and span in 409, I'll have this place ship-shape in a moment. No, you could have asked for them to do all that. So that's initial direct costs. It is incurred by the lessor. In a commercial lease, normally you'll have them put the walls up for you. They'll hang the drop ceiling and put the lights in. You know, things like that. You negotiate that up front. I'll lease this office space for the next 5 years with a 5-year renewal if you make it look like I want my office to look. So those are direct costs. And then how long is the term? Those are really what you need in order to calculate these things. Okay? So let's do an example. Here's a piece of equipment. The lessor is Starling, and they rented to Cardinal. The term is 5 years. It's non-cancelable, and $50,000 at the beginning of each year. Now, do you all remember your present value tables? That is at the end of Chapter 5. There are 5 tables back there. We've been dealing in this course with tables 3, 4, and 5. Back when we were calculating bonds, for instance. And we also used them when we did non-interest-bearing notes receivable and non-interest-bearing note payables. Okay? 4 was a present value of a single dollar. If I'm going to pay you $100 5 years from now, what is that worth today? Table number 4 is an annuity If I'm going to pay you $100 a year for the next 5 years, what's that worth today? And I give you your first payment a year from now. Table number 5 is what is known as an annuity due. The difference between 4 and 5 is that first payment of $100 is due a year from now. So that payment is not worth $100 today. But what if I switched it around and I gave you 5 payments starting today? I gave you $100. What's the payment of, what's today's payment worth today? Just the 100. See? If I give you one of these. One of these. As opposed to one of these. You don't want one of those because that's Chinese. That's only worth 16 bucks. You don't want that. If you got the option, take the green one. Always take the green one. Although they're kind of off blue now. They're not even green anymore. So, okay? It's worth $100 today. That's what this lease is. The $50,000 first payment on this 5-year lease is actually worth $50,000. So you'll see table number 5, row 1 is all a factor of 1. Okay? So we'll be using those when we do problems on Tuesday. So the cost and the fair value of the equipment is $300,000, and it has an estimated economic life of 10 years. There is no guaranteed residual, and the equipment reverts back to the lessor at the end of the lease. There is no bargain purchase option. And then it goes down and it tells you what the present value of those annuity due under Table 5, that factor under 12% discount, is 4.037349. So the present value is $201,867 on those 5 payments. So does it meet criteria 1? Does the equipment revert to the lessee at the end of the lease? No. It reverts back to Sterling, which is the lessor. Is there a bargain purchase option? No. Is the lease for 75% or more of the economic life? The economic life is 10 years, on here somewhere. 10 years, and the lease is 50% of the life. No. Is it 90% of the fair value? The equipment is worth $300,000. The lease payments have a present value of $201,000. No. So no, 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 and no. It's an operating lease. Debit to prepaid rent because we paid it in January, and credit cash, and then expense it at the end of the year, or monthly. I would do it monthly. Okay? Yeah, we'll worry about contingent later. Okay. Let's look at another example. I talked about executory costs. This may be something that's built into the lease. They pay them directly. They may pay them separately. You may sign a lease that says $50,000 a year, plus you pay me $4,000 for maintenance, property taxes, insurance, and stuff like that. So they could be separated, but if it's included, then you need to strip that out in your present value calculation because they're not part of actually leasing the equipment. It's part of maintaining or insuring the equipment. Okay? So that's what that says, that last bullet point here. The minimum lease payment is the lease payment minus the executory cost paid. Discount rates is going to be given to us in each problem, so this is where you're getting it from, because you need to be able to present value that based upon some sort of interest rate. These are contingent rates. I already talked about copiers. You know, the rental payment is Could be based on number of copies made, could be based upon number of miles driven. So you need to estimate that and then present value that in order to make sure that you do or do not exceed that 90% threshold. And then if it is a capital lease, you're then just going to depreciate it. All right? So if it meets one of those 4 criteria, you need a debit to depreciation expense on leased equipment and a credit to accumulated depreciation leased equipment based upon whatever your depreciation policy is, whether you're doing straight line or whatever. All right, so how long do you depreciate a capital lease? The answer is, it depends. If it meets one of the first 2 criteria, in other words, the property belongs to you legally at the end of the lease. So there's a transfer of ownership or there's a bargain purchase price. You then depreciate it over its economic life. So if you're going to lease a piece of equipment with a 10-year life for 8 years, and it's at the end of the 8 years, you could buy it for $1, you're going to depreciate it over 10 years because you're still going to own the thing at the end of the lease. It's not going back to the lessor. If it meets one of the latter 2 criteria, in other words, at the end of the lease, it does go back to the lessor, you do not get to own this property going forward, then you're going to depreciate it over the term of the lease. Okay? So if there wasn't that $1 bargain purchase price in that example I just gave you, 10-year property that you're leasing for 8 years, no transfer of ownership, no bargain purchase price, then you're going to depreciate it over 8 years. Because those last 2 years, you don't physically have the property anymore. You gave it back. All right? So that's how much we use. All right, second example. 4-year lease term, lease payment at the end of each year, so we're back to table number 4, $32,923.45. And I'll just give you a hint now. In all the homework problems and on the midterms, if I give you some sort of odd number, it more than likely is equal to 100% of the present value of the fair value of the asset. Okay, so that's where that number comes from. The cost and fair value of the equipment at the inception of the lease is $100,000, a 0 residual value. There's no guarantee of residual value. There's executory costs for maintenance of $4,000 per year, separately billed. It's not included in the $32,000. It reverts to Dove, which is the lessor, so you're going to give it back at the end of the 4 years. There is no transfer of ownership and no bargain purchase price. Straight line is what the lessee uses for depreciation. So the present value of an ordinary annuity for 4 years at the implicit interest rate of 12% is exactly $100,000. So, transfer of ownership? No. Bargain purchase price? No. 75% of the useful life? Useful life is 4 years, lease is 4 years. It's 100%. Yes. Stop right there. Capital lease. But the fourth criteria is 90% of the fair value. The fair value is $100,000. The present value is $100,000. Yes. So the last 2, you then are going to debit leased equipment when you sign the lease and credit capital lease obligation. You're going to put it on the balance sheet and create a liability. Then what do you have to do? You'll recognize this in a second. What do you have to do with this lease obligation? Because that's the present value of the lease payments. You have to accrue interest. So interest expense is going to be at the first payment that you make at the end of the first year. So you're paying $32,923.45. Interest is $12,000 of that. That's the $100,000 obligation times the implicit interest rate. The difference is going to reduce the liability, $20,923.45. What do you do for year 2? Well, then you got to depreciate. I think I got that on here. Yeah, you got to depreciate it 4 years, 0 residual value, $25,000 under straight line. So what about second year? And then pay the maintenance expense. Second year, you're going to take the $100,000 that has now been reduced by that first payment of $20,923.45. That leaves you with a balance in that obligation of $79,076.55 times 12%. Interest expense is now $9,489. Does this look familiar? It's a basic amortization schedule. You started at $100,000, you slowly whittle it away down to 0 as you make the payments. Okay? We'll do, like I said, problems at the end. Because this is an ordinary annuity. Here's the depreciation. Okay. Oh, is the capital lease current or non-current? Next year's payment, the payment you're going to make within 12 months, is a current liability. You need to take that capital lease obligation and split it between its long-term portion and its current portion. And that's what you do here with this here. Because next year, this $23,000, which is the principal payment you're going to make, that's a current liability. Everything else, the $55,000 remaining, is long-term. Okay? And so you got to reclass that at the end of every balance sheet between current and long-term. Okay. Couple of last items. What if it's if it's an annuity due? Okay? So the same example, except the first lease payment is due at signing. So now the $32,923.45 under an annuity due is really worth $112,000. So the fair value of the equipment, and this one's a little weird, and I'll be doing a problem on Tuesday, but look what happens here. You started with an obligation of $112,000 the day you inked the lease payment. All right? That's your fair value, the present value of all future lease payments. However, at that same moment in time, you signed a check and handed it to the lessor, thus reducing by 100% of that lease payment that obligation, taking the liability down to only $79,076.55. At the end of the year, December 31st, that times 12% is only $9,489. Because you're not making a cash payment that day, all you're doing at that point is debiting. I would have debited, well, you're debiting interest expense. I would have credited interest payable. The book, for some reason, credits this capital lease obligation. 6 of one, half dozen of the other. Doesn't matter. It's a liability and a liability. And it's a current liability. So you see their capital lease obligation increases by the amount of the interest for 1 day. You accrue it here and you pay it on January 1, the next day. And then reduce it. Interest, the second year is the $55,000 times 12%, increasing it for 1 day once again. The next day you make the lease payment, and so forth and so on, until the final lease payment, in which case the liability goes to 0. And I'll do both problems, both style problems, on Tuesday. Okay? All right. If there's a bargain purchase option included that isn't $1 immaterial, this one has a $2,000. When you're calculating that 90% threshold, you have to go to table number 3 and take the present value of that bargain purchase option. In this case, it was $2,000, and add that when you're comparing it to the fair value of the asset. All right? Because it's all lease payments, including the bargain purchase option. Okay. All right, what about a lessor? 2 more minutes. We'll be done. A lessor, they also have operating and capital leases. For operating leases, it's just a debit to cash and a credit to rent revenue. Straightforward. If you're the landlord of an office building, that's what you get at the beginning of every month. Everybody sends you rent checks. Okay? There are 2 types of capital leases from the lessor, a sales type or a direct financing. And the treatment is very similar. Subtly, there's some different. One has dealer profit in it and the other one does not. That's all the difference is. And I'm not going to focus on that. The likelihood of you getting one of those questions on the CPA exam is minimal. Just take C and move on. Okay? It's just the chances of you running into either one of these in real life outside of you having a corporate aircraft. Like if you go to work for a company that has an aerospace division, they do this sort of stuff because the company will buy it and then in a separate company and then lease it back. So they do this kind of crap. But anyway, and heavy equipment also does it. Okay. Operating lease, it's just you're going to get payments at the beginning of the year of $50,000. So you're going to debit cash, and this is an operating lease. So you debit cash and credit deferred rental revenue because you're getting it at the beginning of the year. And of course you have to go out and buy the equipment that you're leasing. All right? Okay. That's it. Have a good weekend.